If budgets are never 100% accurate, why do we create a budget? Well, let's look at the pros versus the cons. The reason we create a budget, an operating commitment of resources to achieve goals in a specific period of time, is to give us a baseline to measure our progress against. Are we reasonably close? Are we going to achieve the goals that we set out? Even if our numbers are a little off on the revenue or the units or the margins, are we close enough for reality? If you have a budget that is 100% accurate, you have a situation where you have controlled or been able to control 100% of the marketplace. That's highly, highly unusual. So the reason we create a budget is to give us a baseline, number one, because it's quantifiable, number two, which means we can measure and know the variation, the good, the bad, the plus, the minus from our baseline. It is a systematic approach. In other words, by creating a budget, we are forced to look at, we're forcing ourselves to look at assumptions, variables, outputs. We're forced to make decisions, to make choices that in most cases are going to be to the benefit of the organization. That's why we have to create a budget. It gives us a structured, consistent way to predict as accurately as we can our financial future. Therefore, the budget can be justified assuming we have vetted, challenged, validated the assumptions. Doesn't mean it's guaranteed, it means it's justified. Those are the reasons to create a budget. Now, what about the reasons not to create a budget? Well, first of all, as many of you know, you've experienced, a budget is always wrong. All right, so that's a little strong. Budgets are always somewhat different from what we actually achieve. That's okay. Unless you have a real requirement to achieve 100% of your budget, it's not a concern. If the budget is significantly or materially different from what we create, the actuals, that's a problem. But the fact that it's not 100% on target is not the end of the world. Another reason that sometimes people don't like budgets, they're subject to manipulation. And I think this has more to do with people's desire to achieve what they commit to than anything else. And when we create our budgets, if we use the right tools, we can minimize the need and the opportunity to manipulate the budget and make it more practical rather than meeting someone's personal agenda. Budgets, because of the previous two con points, are frequently ignored by people. Yeah, we've got a budget, but I'm going to do my job. Well, if we want to use a budget to its best benefit to us, we need to change that attitude, which means we also have to eliminate point four here. That's the budget dance. And many of you have seen this. You're preparing your budget, management's going to reduce it by 10%, so you inflate it by 20%. Management knows you're going to inflate your budget by 20%, so they reduce it by 15%. And it goes back and forth. A, that's a waste of time. B, that's a true example of manipulation that builds lack of trust. If we come up with a budget tool, a budget model that we're highly comfortable with, and we approach it consistently and properly, we can reduce this. And I'll give you a very specific example. One of the largest, most complicated businesses in the world is GE. They're in over 200 different industries and operate in virtually every country in the world. They put together, negotiate, and approve their global budget in 6 weeks. There's nobody that is more complicated than GE. So no one should take more than 6 weeks to create and implement their budget. Most of the historical data we have access to. We know when the budget is due. All we need to do is look at what are the specific goals we need to achieve, what are the limitations we're given, and figure out an appropriate budget to achieve that. And that's the approach at GE. And if we can get more organizations to take that approach, create much better budgets in a much shorter period of time. So let's look at the traditional budget that most organizations use. First of all, it's made up of 4 different components. The main component of every budget, which is also called the master budget, is our operating budget. It says, how many units are we going to sell, whether it's product or service? What are we going to spend to achieve that? There's our production budget, the number of units versus the actual revenue for sales. What are the specific costs, both fixed and variable, to produce that number of units? So this could be an accounting firm producing financial statements and tax returns, or a product company producing 1 billion pens. What level of inventory do we need? How are we going to account for that? LIFO, FIFO, etc. What is our ordering cycle? How far in advance do we need to buy our inventory? At what level? At what inventory reorder points, safety stock, etc. The bottom line of our operating budget is the profit and loss, because it's basically going to take all these different units and turn it into a traditional income statement. It'll generate revenue minus cost of goods, gross profit, operating expenses. Or if we're using the managerial approach, revenue, variable costs gives us our contribution margin minus our fixed costs will give us our operating profit. The operating budget starts with what's our revenue going to be and ends with the income statement. The bridge between the operating budget and the financial budget is that P&L. It ends the operating budget, starts the financial budget. Some of you may be remembering our link between our income statement and our cash flow statement. What was the bottom line in the income statement? Net income. What was the first line on the cash flow statement? That same net income. There was your bridge. So that's how the operating budget is linked to the financial budget. Our financial budget is a budgeted or a projected income statement. Based on this, an ending balance sheet. Remember, we have an opening balance sheet that closed the last budget period, and our cash flow statement. But there's a 4th financial statement here. That's the cash budget. This is not a financial statement that we report externally. The first 3 are. The cash budget is a more practical approach than the cash flow statement. The cash budget breaks our cash in and out using pure cash accounting. What cash collections come in on a given day, week, or month. What cash payments go out on a given day, week, or month. The cash budget is critical to knowing how much cash we have, how much cash we need, if we need to go into our cash reserves, and when, if we need to secure a line of credit at the bank to bridge those times, and when we can repay it. Cash budget is a critical tool for our cash planning internally, and it is the tool that the bank looks for to determine if they will grant us an operating line of credit or not when we request it. And almost every organization can use one, and properly managed, it's an excellent tool for managing our liquidity. And we can talk more about that later. So we go from our operating budget to our financial budget. Every budget has those 2 components. What many budgets also have, but are not required as part of our budgets, is both a capital budget and a discretionary budget. A capital budget is only required if we have new capital spending. So going back to our capital budgeting that we talked about in Module 6, if they're in the current period, as we're projecting forward for the next year, we have no capital expenditures, there will be no capital budget. If, on the other hand, we plan any new capital expenditures, then the capital budget will say, what expenses are we going to have? What cash outflows? What investments are we going to have in the current period to fund that project? What revenue, if any, will be coming in? So remember, with many capital projects, we will have costs or expenses going out for 1, 2, 3, 4 years even before we generate any revenue or cash inflow to offset that. What, if any, non-cash deductions, amortization, depreciation, depletion will we have? That'll generate on those what level of net income and what level of cash flow. And remember, we don't stop at the net income. Capital budgets get all the way down to the net cash flow for the reasons we discussed previously. It's how we measure capital projects as to either achieving their targets or not, either adding to the corporate value or not. So that's our capital budget, which is optional. The fourth segment here, the discretionary budget, is the part of the budget that truly is discretionary to us. If we have the money, if we have the plan, do we want to invest in training, and if so, how much and when? Research and development, public relations, etc. Now, being a trainer, I'll tell you that training should not be discretionary, it should be mandatory. But of course, not every organization agrees with that. And when times are challenging, training seems to be one of those areas that is frequently reduced, which is unfortunate because virtually every study says solid training today is really an investment rather than an expense and improves an organization tomorrow. But most organizations look at training as discretionary, therefore it's on the right side here and may or may not be included in the budget depending on the organization's needs.